balance sheet, the statement from which you get how strong, how powerful the company is the company debt ridden, will the company be able to survive, what is the position. This is something that you can easily get to understand if you know how to read the balance sheet. So balance sheet, a very very vital statement, and we're going to discuss in this particular video the format, what to understand, what not to understand. We're going to have a bird eye view about how balance sheet looks like, how it is get formed, and then when we jump onto ratio part, you should be able to easily understand how ratios are to be calculated, how to interpret that, and where it will start to make a lot of sense for you. So let's jump into the balance sheet part. I hope you're ready. Myself, Amit Popat, chartered accountant by qualification, and I'm doing the investing master series so that you can take your investing decisions in a better way, informed way, rather than based on some tips, some news channel, some telegram channel. This is something I don't want to do. This series is to empower you, to help you, right? Awesome. So, as far as balance sheet is concerned, balance sheet typically shows the position of company's assets and liabilities as on a particular date. So, understand this. There is a difference. Okay. Uh, Income statement is for a period. Like we talked in the last particular video. Income statement is prepared for the year or for the quarter or like that. For which period it relates to. But when we talk about balance sheet, it is not for the period. It is not for the quarter. It is not for the year. It is as on date. Like if I'm preparing the balance sheet as on 31st March 2025, then it shows me the position of assets and liabilities that company holds as on that particular date only, not even of 31st, 30th March, just one day before. Okay. So I hope this should be absolutely very clear to you. If it is clear, just type in clear in the chat box, because this funda is something that you need to understand. If you're coming from a commerce background, you might think like, oh, Amit, what are you talking about here? I've learned this in 11th or 12th. But my dear friend, those people who want to make money, those who want to compound what money, but they're not coming from a commerce stream, or they are, new to this. For them, even this piece of information is very, very valuable, right? Thank you. And I've tried my level best to keep this investing mastery series in such a way that an absolute newbie, matlab, even if somebody has not studied at all, he should also be able to understand this. The only thing is he should be able to understand English. I've kept this series throughout English because early when I used to record videos in Hindi or mix of that, I got many reviews from the people of southern India that they are not able to understand that. So I thought, let me do this in English, because people in southern region, they can understand this easily, and people from northern, western, or eastern region, or Madhya Pradesh and all that, they're very good at English. So English is some one language that everybody understands. So this series has been kept in English. That's the logic for that as well. So now let's have a look at how does the balance sheet look like. So on the balance sheet, on the left hand side, generally liabilities are shown. Here I'm trying to explain you the pro forma, so I'm not keeping that vertical format. My intention over here is to show the components, how it is formed. Okay, amount on the right side will show assets, and again, we will have amount. It is not actually assets, it is amount, just it's a typo, understand that. Let's say for example, a fixed asset worth of 1 lakh rupees is there in any particular business. It could be the laptop, or it can be some furniture. So company has got 1 lakh rupees of fixed asset. Fixed asset means, now what is the definition of fixed asset? The definition of fixed asset is, if I talk purely from an accounting perspective, the definition of fixed asset is any asset benefit of which arises for more than one accounting period. Like if you got a laptop, you will use the laptop for 2 years, 3 years, 4 years, and maybe more than that. If you got a plant and machinery, if you purchased a plant, but naturally you will use that plant for next 10, 15 years. If you built a factory, definitely that factory is going to stay with you for next 25, 30 years. If you bought trucks, if you got any sort of these assets, the benefits of which will accrue to you for more than one accounting period. Ideally, they are known as fixed assets. Ideal examples are plant and machinery, vehicles, trucks, factories, shop, furniture fixtures, computers, laptops, everything. The benefit of this accrue to you for more than one accounting period, right? Second thing is investment. If company has made investments, like it has bought shares of some other company, like if A Limited has purchased shares of B Limited, they had some extra fund and they were not needing those funds in their business, so they thought of investing in other business. Investment may also include your short term long term investment. You might have invested in some bank deposits, or under certain government regulations you got to keep certain amount of fixed deposits or deposits to with the government or with the regulatory authority. So that is something that will also form the part of investment. Let's say there is 20,000 rupees. And third type of asset that will be there in your business is going to be current assets. Now, what do you mean by current asset? Current asset means assets which can be converted into cash within a span of 1 year. Ideally, it is told 1 year, but the real definition is one inventory cycle, one conversion cycle. But conversion cycle is something that we're going to discuss at a later stage. So, as of now, I'll keep it simple for you. Any asset that can be easily converted into cash or that can be easily converted to cash within a span of 1 year is known as current asset, right? Which you intend to convert into sale. Here, your intention is very, very important. So, this includes account receivable, or very popularly we call it as a debtors. Like I was giving example in the last video, like I sold this mic to my friend Raju on a credit. So Raju's name will appear in my accounts receivable, debtors, right? Second thing I have is inventories. I might be having a raw material inventory. I might be having a finished goods inventory. I might be having a WIP inventory, so on and so forth. Like if I'm producing these mics, if I'm Digitic, I'm producing this mic, then raw material could be plastic for me. Raw material could be copper if that is going inside. I don't know actually. So this all things will form a part of my raw material inventory. At the same point of time, I might be having raw material inventories in my factory, but definitely I'll be having this ready mic, ready to dispatch, like this box. Okay, transmitter, receiver, cables, everything packed. This is a finished product. I have got 100 units of this ready with me. So cost of those finished goods will be forming part of my finished goods inventory. For example, that is 75,000. I know you are finding it a bit difficult to see it when my face is there. So what I'm going to do is I'll remove it over here. I'll keep it over here. Now I think you'll feel it better. So that's the inventories. The next thing that we can look at is a cash in bank. You might be having some cash balance. You might be having some cash at the bank. Let's say that amounts to 25,000. So total asset that you have is a 2,70,000. Now the simple fund of balance sheet is all the assets that you have, must be funded by some money. Like if you bought fixed asset, वो पैसा कहाँ से आया? That funding is looked at by the liability side. If you made investment, वो पैसा कहाँ से आया? If you got cash in bank, if you got inventories, if you got accounts payable, how these assets have been funded, right? And liability side are very, very crucial for survival of any business. We'll talk about that. So what I'm going to do is I'll again bring my image, my camera to where it was, so that you can see the liability side in a good way. Okay, I'll keep it a bit over here so that you can see the amount of assets as well. So first thing that generally comes is owner's equity, and for example, let's say in our business it is 1.5 lakh. The promoter or the owner, they bring this. If we talk about a company's form, this is something equity share capital plus preference share capital. which is company's own capital. Like let's say understand that in a proprietary business, if you're starting a new business, you want to buy fixed asset of 1 lakh, you want to buy inventories, you want to do that, and for that you brought 1.5 lakh from your own pocket, your own savings. That is what we call as owner's equity in terms of proprietary business. In terms of partnership or company, specifically for a company, it will include equity share and preferential capital. Then non-current liabilities. So you wanted to buy assets worth 2,70,000 rupees. 1.5 lakh is your own saving you put in your business, but still you need more money. So you took loan, 10 years loan on which you will pay fixed interest. As we saw in the income statement video, we paid a 50,000 rupees of fixed interest as well. So those loan, those debentures, they'll form a part of your non-current liabilities, that is say 50,000 rupees. And last is current liabilities. For example, you went to buy the inventories, but you also said that, like Raju said to me, I also said to my supplier that I'll pay money after 1 month, 2 months, 3 months. So that will form a part of my current liabilities. And the fundamental rule that you need to understand is, if your balance sheet is right, assets and liabilities must match. There cannot be, should not be any mismatch of assets and liabilities. Whatever assets you have, it must be funded by something. Like, if I got this phone, this is my asset. But to buy the asset, I must have brought funds from somewhere. If it is my own money, I'll say owner's equity. If I've used credit cards, I'll say, it's a current liability because I got to pay the credit card bill within 3 months. But if I bought a loan to buy this phone, that will be a non-current liability. So please understand that whatever asset you might have in your business, it must be funded by some or the other source, right? So I hope you got a bird eye view about balance sheet. This is just a bird eye view. When we'll get into the ratio part, we'll look into that at more particular depth, but this is something to get you familiar with how balance sheet, what are the components of it. So I hope you are loving this investing master series, you're learning from it. Do let me know what is your biggest learning from this particular video, and I hope you're watching and will keep watching all the videos that we are bringing for you in this investing master series. Thank you so much. See you in the next video, and we will look at the cash flow statement. Thank you.